All right, today we are going to talk about one of the most powerful and honestly most misunderstood signals in all of trading, market gaps. You know those empty spaces on a chart? The ones that just seem to pop up out of thin air? Well, they hold some incredible clues. If you stick with me, you're going to learn not just what they are, but exactly how to turn them into your next big opportunity. Let's dive in. I mean, really think about that for a second. The market closes, you log off, go live your life. And by the time it opens the next morning, a huge price shift has already happened. This isn't just some random fluke. No, it's a footprint. It's a signal that there's been a major shift in what the market is thinking. So what's actually causing that overnight jump or that sudden drop? What is this so-called invisible money that's pushing the market around before the opening bell even rings? That is exactly the puzzle we are about to solve together. Okay, so in this first section, we're going to pull the curtain back on this whole phenomenon. We're going to define what these gaps are and, more importantly, why they are such a huge opportunity for any trader who actually knows how to read the signs. So let's get down to it. What is a gap? Well, it's pretty simple, really. It's just a sharp break in price where zero trades actually occur, and that leaves this empty space on the chart. It's the physical evidence of that overnight move we were just talking about. But look, just knowing the definition, that's not enough. Understanding the why behind it, that's where the real edge is. All right, so let's decode what's really causing these price jumps. I promise you it's not random, and it's definitely not magic. It all comes down to the most fundamental force in any market: simple supply and demand. The secret ingredient here is a massive order imbalance. Just think about it for a second. The main market might be closed, but the world keeps on spinning, right? Big news still breaks: earnings reports, product launches, global events. And all that news makes traders flood the system with buy or sell orders after hours, building up this incredible pressure that has to be released at the opening bell. And this really breaks down into two super clear scenarios. On one hand, you get some great overnight news. A tidal wave of buy orders piles up. Demand just completely crushes supply, and boom, the stock is forced to open way higher. That's your gap up. And of course, on the flip side, some bad news drops. A flood of sell orders comes in, supply totally overwhelms demand, and the price just tanks at the open, creating a gap down. It's pure, raw market sentiment on display for everyone to see. But here's where things get a little more interesting, and honestly, this is the part that every trader needs to understand. Not all gaps are the same, not even close. Knowing which type of gap you're looking at, well, that's the key to using the right strategy. There are four main types you have to have in your toolkit. Okay, think of this table as your strategic cheat sheet. First up, you've got the common gap. This is basically just market noise when a stock is moving sideways. It usually fills pretty quick and isn't a huge deal. But then you have the breakaway gap. Now this is the starting pistol for a powerful new trend. Next is the runaway gap, which screams that a trend is still going strong. And finally, the exhaustion gap. This is like the last gasp of a dying trend, signaling a big reversal could be coming. Understanding these differences is what separates gambling from trading. Okay, so you've identified the gap, you know which of the four types it is. Now what? How do you actually trade it? Let's get into the good stuff, the actionable plays. We're going to focus on the two main strategies you can deploy, depending entirely on the context. But before we get into the strategies, you have to understand the gap fill theory. There is this incredibly strong tendency for the price to want to go back and fill that empty space. Now, why does that happen? Well, it's usually a mix of early profit-taking by people who caught the gap, plus the market just kind of correcting itself after an emotional overreaction. Just think of that empty space like a magnet, constantly pulling the price back toward it. So here are your two main plays. Strategy number one is to fade the gap. This is where you trade against that initial crazy move, betting that the gap is going to fill. This is your go-to move for common gaps or exhaustion gaps, especially if the price gaps right into a known heavy resistance or support level. Then you have strategy two, the gap and go. Here, you do the opposite. You trade with the momentum, betting the trend is just getting started. This is the perfect play for those powerful breakaway or runaway gaps, especially if they happen on huge volume. Now look, we can't talk about all these cool strategies without talking about risk. Let's be real. Trading gaps can be incredibly profitable, but they can also be wild and volatile. So let's cover the single most important rule you need to follow to protect your capital. This right here, this is the golden rule. I want you to memorize it, burn it into your brain. That empty space on the chart, it isn't just empty space anymore. It becomes a powerful psychological level of support or resistance. If a stock gaps up, the area it jumped over now acts like a floor. If it gaps down, that area becomes a new ceiling. So here's exactly how you put that rule into practice. It's a simple 3-step process. First, you identify the gap and that new support or resistance level it just created. Second, you plan your entire trade around that level. And third, and this is the most important part, you place your stop loss just on the other side of it, either inside the gap or just below the candle that kicked the whole thing off. This is non-negotiable. This is how you protect yourself if the trade turns against you. All right, let's bring it all home. The number one takeaway from all of this is that context is king. You absolutely cannot just blindly trade every single gap you see. That's a recipe for disaster. You have to first figure out which of the 4 types you're looking at, then choose the right strategy for the job, either fade or go, and you must always honor that gap as a critical support or resistance level for your risk management. And that's a wrap. The next time you see that empty space on a chart when the market opens, you're not going to see random chaos anymore. You're going to see a clue. You'll see a story about supply, demand, and what the market is really thinking. So the only question left is, which opportunity will you be looking for?